The stock market, often regarded as a financial labyrinth, has the power to turn dreams of immense wealth into reality for many investors. The prospect of making millions through stock trading tantalizes the imagination of newcomers and seasoned investors alike. However, navigating this intricate world necessitates a deep understanding of strategies, risk, and mechanisms that govern it. So today I'll take you to how to cash in big on the stock market. If you're new to the channel, hit that subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. At its core, a stock or share represents a slice of ownership in a company. Shareholders possess the right to vote at annual stockholder meetings, influencing critical company decisions. Additionally, they are entitled to a portion of the company's profits, typically distributed as dividends. This dual aspect of ownership and profit sharing forms the basis of stock investment. Stocks are traded on stock exchanges, where investors can buy and sell them through traditional brokerage terms or online platforms like E-Trade or Robinhood. Notably, these exchanges such as the New York Stock Exchange, London Stock Exchange, and Shanghai Stock Exchange are the global hubs where all listed stocks are bought and sold. The price of a stock is determined by the forces of supply and demand. When an investor is willing to pay more for a share than its current market price, the price rises. Conversely, if buyers are scarce and are willing to pay less, the price drops. While this may appear straightforward on an individual stock level, the stock market's complexity arises from a high volume of transactions that occur daily, leading to price fluctuations and volatility. Speaking of volatility, the stock market is notorious for this, with prices constantly fluctuating due to rapid trading and a myriad of influencing factors. Popular stocks in particular tend to be more volatile, as they are subjected to intense trading activity. This volatility often perplexes investors and reinforces the perception that the market lacks stability. With thousands of transactions occurring daily, some within mere seconds, the potential for criminal activity looms large. Two prevalent forms of security frauds are insider trading and pump and dump schemes. Insider trading involves trading stocks based on non-public information, while pump and dump schemes entail artificially inflating stock prices to entice investors, only to later sell them off at a profit, leaving unsuspecting investors with plummeting shares. In the United States, the Securities and Exchange Commission, or SEC, and its British counterpart, the Financial Conduct Authority, FCA, are at the forefront of ensuring that the market remains a fair and transparent playing field. These regulatory authorities carry out a multifaceted role that encompasses monitoring, investigation, and enforcement. They vigilantly oversee market activities, scrutinizing transactions and behaviors to detect any signs of suspicious or unlawful conduct. When irregularities are identified, they initiate investigations to cover fraudulent activities and violations of securities law. The primary objective of these regulatory bodies is to maintain the integrity of the market, protect investors from potential scams, and uphold the principles of fair trading. By doing so, they contribute to the confidence and trust that investors have in the market, thereby facilitating its orderly functioning. Now that you're aware of how the stock market functions, let's take a quick glimpse at a strategy commonly used by investors: the buy low, sell high strategy. This straightforward yet powerful strategy hinges on the basic principle of purchasing stocks at a lower price point and subsequently selling them when their value appreciates, resulting in a profit. The key to executing this strategy effectively lies in accurate market timing and a profound understanding of stock valuation. Investors keen on maximizing their returns meticulously analyze market trends, company financials, and external factors that may impact stock prices. This analysis forms their decisions about when to buy, ensuring that they acquire stocks when they are undervalued or poised for growth. Equally crucial is the timing of the sell decision. Successful investors closely monitor their investments, recognizing the optimal moment to divest their holdings for a profit. This requires a keen awareness of market sentiment and a disciplined approach to capitalizing on favorable price movements. In essence, the buy low, sell high strategy is the bedrock of many investor success stories. It embodies the fundamental concept of capitalizing on market efficiencies and fluctuations to generate wealth over time. But this strategy isn't the only one. Investors can adopt different approaches in the stock market, with day trading and long-term investment being two primary strategies. Day traders engage in short-term buying and selling, often within the same day, capitalizing on intraday price fluctuations. Due to the inherent risks and potential for excessive trading, day traders may be subject to regulatory constraints. In contrast, long-term investors take a patient approach, holding stocks for an extended period, often years or even decades. This strategy aims to benefit from the long-term growth potential of companies, focusing on fundamentals rather than short-term market noise. By the way, if you're enjoying this video, please take a moment to like and subscribe. It really helps us spread the Thrive Wise love so we can help more people thrive wisely. And going back, while day traders aim to accumulate small, quick profits over time, long-term investors have a different objective. They seek substantial gains from a single investment that appreciates significantly over time. This approach relies on identifying stocks with the potential to increase in value over months or even years. It is a strategy that requires patience and a belief in the underlying strengths of a company. Long-term investors often capitalize on opportunities during a stock's initial public offering or IPO, or when they perceive a stock to be undervalued. The primary goal is not immediate returns, but rather the anticipation of substantial growth in the future. In stark contrast to long-term investment, short selling is a strategy that involves profiting from a stock's decline in value. When an investor short sells a stock, they effectively borrow shares from their broker, sell them at the current market price, and commit to repurchasing these shares at a specified future date. The profit in short selling comes from the difference between the initial sale price and the lower repurchase price. If the stock's price drops, the investor gains. However, if it rises, they must pay the difference, potentially resulting in substantial losses. The allure of unlimited profit potential in short selling is counterbalanced by the inherent risk. When the market price increases instead of decreases, investors may be forced to cover the difference, potentially leading to significant losses. Short selling is not for the faint of heart and requires a keen understanding of market dynamics and risk management. For investors seeking a more stable income stream, dividends offer an appealing option. Dividends are regular payments made to shareholders by a company, typically funded from profits or cash reserves. These payments can temporarily increase a stock market's price, although the effect is typically limited to a period leading up to the dividend's payment date. Investors who prioritize consistent income often choose stocks from companies with a history of issuing substantial dividend payments. Such companies tend to attract long-term investors who appreciate the reliability of these periodic payouts. And then there's stock splits. Sometimes companies decide to split their shares, resulting in an increase in the number of shares owned by each shareholder. For instance, in a 2-for-1 stock split, an investor holding one share before the split will own 2 shares afterward. While the number of shares increases, the total value remains the same, as the market price is adjusted accordingly. Stock splits are typically carried out by companies aiming to lower their market price per share, making it more accessible to a broader range of investors. Although the total avenue of investments remain unchanged, stock splits can influence market perception and trading activity. Now that you have a grasp of how you can gain money in the stock market, you should be aware of the scenarios that often reside in it, which is, firstly, takeovers. When a corporation decides to buy another company, it leads to a takeover. In this situation, Corporation A seeks to acquire a majority of Corporation B's stocks, enabling them to gain control of the company. During this process, Corporation A usually makes an offer to the shareholders of Corporation B, who would then decide whether to accept the offer. Buyouts can occur through various means, including external companies or groups of internal investors seeking to reprivatize the company. This process is akin to a hostile takeover, but involves offers from internal resources, rather than competing corporations. In the world of stock market investing, there are diverse strategies to suit different objectives and risk appetites. Long-term investors focus on finding stocks with growth potential over time, while short sellers profit from declining stock prices. Dividend seekers prioritize stable income, and stock splits can impact the accessibility of certain stocks. Buyouts and takeovers add another layer of complexity to the market. Ultimately, success in the stock market hinges on a combination of factors, including diligent research, risk management, and a well-defined strategy that aligns with one's financial goals and investment horizon. While the stock market can offer lucrative opportunities, it is essential to approach it with careful consideration and a clear understanding of the chosen investment strategy. Well, that's basically how to cash in big on the stock market. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.